Hi, and welcome back to October 3's Pension Finance Update. I'm John Lowell, and with me as usual is my partner, Brian Donahue. So Brian, it looks like May of 2024 was just a repeat of a pattern we've seen for so many months, almost dating back to when COVID first came to the US. Is that the same pattern you're seeing with pension finance this month?
I think that's exactly right. Summary version being another good month for pension sponsors. This is, as you say, a pattern that we've seen going back 4 years. A simple, but I think useful way of thinking about a good month for pension sponsors. And what we mean by that is it's a month where returns on stocks outpaced returns on bonds. In a sense, this is the proposition at the heart of financing retirement promises with stocks, that over long enough periods, stocks ought to outperform bonds. And so that's just going to be a more cost-effective way to finance retirement. Or we see what we saw last month. Now, there's a month where interest rates actually came down about 15 basis points. But in sympathy with that, stocks actually rose. We're up about 5%. So the net impact is incremental improvement. So the real remarkable thing isn't so much about stocks outperforming bonds over the long run. It's just the remarkable consistency we've seen each and every month this year, and pretty consistently going back, say 4 years. If we look over the last 4 years, typical bond fund has probably lost about 20%. Stocks are in the same time are up maybe 50 or 60% on average. So that's the sort of fuel that translates to good news for pension sponsors. When we look at our 60/40 plan, our so-called Plan A, we see through May, the plan has improved about 8% this year. The messaging that we've been rolling out, we just want to beat that drum one more time, with the improved higher interest rates, lower cost for settling liabilities, improved funded status. We're seeing probably another record year in the annuity purchase market based on data through the first 5 months. Real appetite there. Many long frozen plans have seen a boost in their funded status and are in a position to terminate. So we think there's a lot of activity there for employers getting out of the business. We know pension surplus is a conversation that's back on the table. Plans looking at the outperformance over the past several years, now looking at surplus assets and how do we manage that. A lot of interesting conversations in the pension world right now.
So I guess where that leaves us then is probably for the first time, maybe this century, we're really seeing that of the pension plans that are out there, the bulk of them now are in a surplus situation. They've got more assets, and in a lot of cases, meaningfully more assets than they do pension obligations or liabilities, if you prefer. With that really being the case, we still see that a lot of organizations are spending a lot of money. They're spending a lot of money on things like PBGC premiums, and that's at a time when PBGC doesn't need the money. Is that a fair statement?
In my opinion, yeah, that's 100% on. We have the data, from 2008 when PPA came in and the PBGC premium regime started its relentless increases. Between 2008 and 2023, PBGC has collected $66 billion from single employer plans. This is a $2.5 or $3 trillion industry. So that's a couple percent of total plan assets has been shipped off to PBGC since 2008. And if you look at the most recent PBGC financial report, they tell us they've got $45 billion in surplus assets in their single employer plan. If I just take a moment to think about the pension sponsors that have been operating under the burden of that $66 billion, these are not tech companies. These are not the new economy. These are manufacturers, union plans, hospitals, meat and potato companies that have had these premiums dropped on their heads. So I think it's high time that Congress take a look at that situation.
So that's an interesting segue you just gave me there. One of the committees in Congress that is among the most influential in the pension world is what's known as the Senate HELP Committee, HELP standing for Health, Education, Labor, and Pensions. And back in, I believe it was late February, they held a hearing with some industry experts that they invited because they have a real concern about the ability of American workers to be able to generate retirement income for themselves, to get that guaranteed lifetime income so that they don't have a fear of outliving their wealth. That was followed by a request for proposals, but not in the sense we think of requests for proposals as consultants, but they really wanted legislative proposals. They want ideas to create more corporate or private sector defined benefit plans, if you prefer. How do we get more employers to offer those benefits to their employees? And as part of those proposals, a number of organizations, some of them you might think of more as lobbying groups, others more along the think tank side, did present proposals. They tend to have a lot of commonality to them. One of those common themes is that they all view that PBGC premiums need to be reformed. And that's probably a good thing. It's not that we want the PBGC to be underfunded or starving for money, as they were probably at one time. But right now, they really do have enough money. And one of the reasons that there's always an incentive to get them more money is PBGC premiums are what are known as on budget. So to the extent that PBGC collects what we might think of as too much money, that works out well in scoring a bill. So it's a very mixed message there. But in any event, the Senate did ask for these proposals. They've been very receptive and have asked for follow-up Q&As on those proposals. Certainly more to come on that, but they are very in tune with what the profession is thinking right now in terms of getting more defined benefit plans of one sort or another out there. How do they provide incentives, whether they be financial incentives or just more psychological incentives for companies to start new defined benefit plans, to restart plans that are frozen, and to keep plans going that are already going. There will be more to come on that, I'm sure, in the months ahead. But for now, I think we'll just leave it there, and we'll look forward to seeing you again on next month's Pension Finance Update. Thanks so much.